If you have ever checked your mortgage rate, your credit card statement, or the price at the grocery store and wondered why nothing is getting cheaper, here is something most people do not realize. Washington just pushed the nation's total debt past $40.047 trillion, and that headline shows up directly in what you pay every month for your house, your car, and your groceries. Today I am going to show you what that $40 trillion actually is, where it came from, how it lifts your interest bill, and 3 rules that keep it from draining your paycheck. Before the numbers, here is the lens. Every dollar of debt gets read 2 ways. First, compare the balance to what you earn per year. Then multiply the balance by the interest rate to see the cost per year and per month. The wider the gap between growth and income, the less certain your budget becomes. Every number in this video gets read through that lens. On Tuesday, the Treasury's daily statement showed total public debt outstanding at $40.047 trillion. That is not one pile. $32.266 trillion is held by the public, investors, banks, and foreign buyers who expect interest. $7.782 trillion is intra-governmental, money the government owes to itself for programs like Social Security. Think of it this way. If you compare that $40 trillion to the size of the economy, it is like a household earning $60,000 a year while carrying $200,000 on credit. The chart is the punchline. The split shows how much is already in the market setting your rates. That is not ideal. That split matters because only the public portion directly raises the price you pay. More supply of government bonds pushes yields up, and yields are the benchmark for mortgages and car loans. We did not get here in a year. Federal debt has doubled as revenues were held back by tax cuts while costs for safety net programs and interest kept growing. During Trump's 2 terms, debt rose by $11.6 trillion. During Biden's 4-year term, it rose by $8.4 trillion. This is not a pullback. This is a repricing of what government borrowing costs for everyone. When Washington borrows more, it competes with you for the same pool of money, and that competition lifts the price of money. Kronos does not do hope. It does math. Taxes were cut without a matching cut in spending, so the gap was borrowed every year. Interest then compounds on that borrowed gap, which is why the total doubles faster now than 20 years ago. Here is how that $40 trillion lands on your bill. The 10-year Treasury yield rose by roughly 0.7% since late February to around 4.7%. The 30-year fixed mortgage followed it and sits at 6.58%. Barely above 6.51% 2 months ago. So if you borrowed $300,000 for a house at 6.58%, you pay about $19,700 in interest in year 1 alone. Multiply that debt by a higher rate, and your cost per year jumps by thousands. That is not a dip. That is the party finding the exit. Gas fell to $3.78 early July, then rose to $4 by July 20th, 88 cents higher than a year ago. Energy moves fast, but the mortgage channel moves your biggest bill, and it has not fallen since May. Credit cards tell the same story at your kitchen table. Balances rose by $21 billion in the second quarter to $1.26 trillion, just shy of the $1.28 trillion record from last year's fourth quarter. The New York Fed called this a K-shaped economy. About 175 million Americans hold cards, and roughly 60% carry a balance and pay interest. More than half carry balances to cover essentials, and 56% say it would take 6 months or longer to pay off. Late-stage delinquency, more than 90 days past due, jumped from 7.6% to 12.8%. New delinquencies held at 6.97%, but elevated. If you own one of these, that line just took your gains. About 60% of those cardholders do not pay in full, so interest at nearly 21% compounds every month. The total household debt sits at $18.771 trillion, with auto debt at a record $1.713 trillion, another squeeze. Housing shows where the cushion is thinning. Mortgage debt fell by $74 billion to $13.117 trillion, but home equity lines of credit rose by $13 billion to $459 billion. $142 billion above the low in early 2022. Only 41% of mortgaged homes are equity-rich, meaning the owner owes less than 50% of the value, the lowest in almost 5 years. About 3% are underwater, owing more than the house is worth. Prices softened in the Gulf Coast states like Florida, Louisiana, and Texas, and more people are borrowing against equity to extend budgets at the grocery store. That is every coffee in Seattle. For a decade, home equity lines rose even as mortgage balances slipped by $74 billion. That switch means people are trading long cheap mortgage debt for shorter variable debt to cover cash gaps. The average new mortgage payment at 6.58% on $300,000 is about $1,900 per month, roughly $400 more than at 5%. That difference, times 12 months, is $4,800 per year you never see. This is why feeling secure is not the same as being secure. 75% of Americans say they feel in control of day-to-day finances, yet 33% could not cover an unexpected $1,000 expense, and 36% will rely on credit for some expenses this month. 64% expect a recession in the next 12 months, and the Bureau of Labor Statistics says the average unemployment spell lasts 24 weeks, nearly 6 months. Start small. Cover your highest deductible with $1,000. Then build to 3 to 6 months of essentials. I hold one of these. I found out with you. If you miss one paycheck, can you cover rent, food, insurance, and debt payments for 24 weeks? If not, the buffer is not 6 months of income. It is 6 months of essentials, saved in a high-yield account, not on a credit line. If you annualize every income claim in this video, multiply the hourly rate by 2,080 hours per year, then compare that yearly income to the debt cost per year. That math turns a vague headline into your personal price per month. Here is the bottom line. Rule 1. Compare every rate to your income per year. A 6.58% mortgage on $300,000 is 6 times what a median renter pays in a year. If the number is more than 30% of your pay, it is not affordable. Rule 2. Multiply and stress test. Take your credit card balance at 21% and multiply. A $5,000 balance at the minimum costs you more than $7,000 in interest and takes decades. Rule 3. Build the sinking fund. Parents plan to spend $863.86 per child for back to school and $43.3 billion nationally. Set aside $75 per month and you have $900 for next year without touching credit. Remember the $40.047 trillion? Meet its future. Your future is the spread you control. Bankruptcy filings topped 500,000 in 2025, 50% more than in 2022, with a 12% jump in June. The filings held $75 billion in assets, but owed $86 billion, $11 billion more. That gap is the cost of waiting. Timestamps for every section are in the description. Subscribe for daily AI finance analysis. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor.